Mark, let's start there. Have you seen a sufficient tightening of financial conditions that you anticipated, or do you anticipate there's more to come?
Hi, Jonathan. Good morning. No, there's probably more to come. I think what's interesting about this point in history is this is the first time the Fed is at zero, about 250 basis points away from neutral, when we're going to grow above potential, 3.5% this year versus 2%. You've got inflation, which even the Fed would admit is going to be above target by the end of the year. Core PCE is probably going to be around 2.9 by the end of the year. And labor market conditions are basically consistent with full employment. So normally when these three things are occurring, the Fed is close to neutral, which would be around 2.5. Right now we're at 0. So they're a long way to go. They're doing the right thing. I think they're adjusting. Inflation has been more persistent. It's because primarily supply constraints. But yes, they're going to have to raise rates, and we think they're probably going to have to raise 4 or 5 times this year.
And that includes balance sheet reduction, Mark?
I think they'll announce something this summer. They're going to start with rates, and Powell indicated that that's their primary tool. But ultimately, we're going to go from this tailwind of not just the Fed, but other central banks around the world buying assets to not only not buying as many assets, but actually over the next 1 or 2 years, shrinking the balance sheet. Fed's balance sheet's $9 trillion. So I think ultimately that's going to steepen out these yield curves and put more of a risk premium. So for those factors, I think you want to still be defensively positioned for higher rates.
Mark, when you make the decision to raise cash, you've instantly got a second decision to make: when to come back in. Mark, walk me through the process you and the team would go through about when and how to deploy capital.
So really, our logic for taking risks down 3-4 months ago was really a function of spreads being very tight, and also the fact that we were seeing inflation persist, and also these supply constraints linger. So we thought the Fed would have to adjust policy. The good news is that now you've got the market priced for 5 rate hikes. Spreads have widened. Equities have come under pressure. So there are some selective opportunities out there right now. But overall, we're running higher cash than normal because we are anticipating a more volatile period ahead, particularly with central banks around the world normalizing policy.
Mark, can we put some numbers on that? What's normal and what's higher than normal, just in terms of the cash allocation?
So, we've been bringing up our cash pretty consistently. Our funds are running right now over 10% cash. And we want to have that cash because we want to be in a position of strength should we get some volatility. The Fed will even admit this. It's a very unusual time. It's very uncertain. A lot of this slack could actually come back. We could see the labor force participation rate rise, and that could take the Fed off the table. On the other hand, these supply constraints could linger well longer, and that could even cause more rate hikes to be priced into the market. So we want to be in a position to capitalize on that potential volatility.
Mark, I want to talk about the volatility just a little bit more. I've spent some time with you guys on the West Coast before, and I remember one thing that you said to me, and it was that we want to be liquidity providers, not liquidity takers. Are you expecting those kind of gappy markets that maybe we've seen on occasion in times before? Is this a price adjustment, a liquidity adjustment, Mark? What is it?
Well, I think ultimately it's when you have all these central banks being so accommodative for so long, it really has eased financial conditions. There's a lot of cash on the sidelines. That has compressed spreads. We're long-term investors. We look at long-term value. And so at these level of spreads, particularly where they were 3 or 4 months ago, we wanted to build up a lot of cash. Pimco tends to make a lot of money for clients in these higher volatile markets because we have the ability to do a lot of reverse inquiry with companies. We can provide liquidity when a lot of people don't have it or don't want to. So we want to take that counter trend. So we're prepared for that should we get more volatility in the months and quarters ahead.
Mark, I was just going through the so-called shopping list: the U.S. consumer, airlines, aerospace, banks, financials, real assets, real estate. Mark, why is real estate on that list for you at the moment?
So we want to have an implicit inflation hedge. And this really gets back to the comment I made earlier about supply constraints. We've seen supply constraints in the labor market, which is causing higher inflation. We're also seeing supply constraints in real markets, which is causing inflation. For example, we've underbuilt for a decade in the housing market. A lot of these apartments in high barrier to entry locations, they reset their leases on a very short duration. So they're the best beneficiary of higher inflation. They're also directly correlated to wages and salaries. So if you look at wages and salaries, you look at the ECI data, wages and salaries in the private sector is up 5%. So these apartments have been underbuilding, and now demand is coming back. So we really like these hard assets, which are benefiting from higher wages and these high barrier to entry areas. So apartment REITs is a big opportunity right now.
One question I just got from a Bloomberg subscriber, and I'd like to throw it over to you, Mark, and you can answer. How does one get real estate exposure in a corporate bond fund? How do you go about doing that, Mark?
So we've been doing that over the last several decades by owning non-agency mortgages, which is really a pure play on housing prices. We do that through owning home builders. We do that through owning timber assets, apartment REITs, building materials companies. So these are all inflation hedges. These companies I mentioned also have been able to pass through higher costs. If you look at the fourth quarter earnings, what you're seeing is labor markets are tight, companies are passing through higher costs, and the supply constraints continue. So this pass-through ability of companies, this is something we pay a lot of attention to on the bottom-up perspective, and we're owning those companies who have this ability to raise prices and pass through those higher costs and higher revenues to the consumer.
Mark, can I pick up on the word you used, hedge? Is that a hedge, or is that a core call within the portfolio? Which one is it?
Well, we like apartment REITs for a lot of reasons. It's not just the fact that they're real assets. The fact that they are an implicit inflation hedge for higher rents and higher wages is another reason. We also, for example, own bank loans. If you look at our funds, we've been increasing our bank loan allocation, and that's specifically on the view that the Fed would have to be normalizing rates. So that's another hedge for higher rates. But in general, we have been anticipating these higher rates, and we have been positioning portfolios underweight duration, and also in implicit assets, which should benefit from reflationary policies as these supply constraints have lingered for longer.
Mark, I'll do the journalist thing, and you can do the investor thing. Make it nuanced, and I'll just be very direct. The biggest risk this year, it was inflation last year. Is it the policy response to it this year? Is it higher real rates this year when it was inflation last year? And can it actually be both? Does that work?
Well, Jonathan, you really hit the key question, and that is, can the U.S. economy, can the consumer, businesses, the housing market handle higher rates? And that's still a question. We don't know the answer. I'm more of the somewhat optimistic view that at a 1.8% 10-year, that's not restrictive. So in other words, the U.S. economy is strong enough to handle higher rates. We'll watch the housing market. That will be key. Inventories are very low. But I think that's really what I'm focused on a lot this year, is will we get a significant slowdown in the consumer as these rates go higher? And I'm open-minded to change my view. But so far, I think the economy is resilient enough to handle moderately higher rates. And remember, you've already priced in Fed hikes. So I think a lot of this rate hike is priced in.
Will you ignore the payrolls report this Friday, Mark? Is that worth ignoring?
No, it's not. Obviously, the number could be 0 because of the Omicron variant.
Yeah.
But what I'm watching most closely is the labor force participation rate. Right now, it's at 61.9. It's low because basically you've had no immigration, you've had a lot of early retirements, you've had lack of childcare, and people fearful. Those things are going to change over time. And so we want to see that labor force participation rate move up. If it does, that potentially could take some of these Fed hikes off the table. If it does not, that means that the labor market's going to remain tighter for longer. And that, in turn, will cause the Fed to probably continue to hike rates.